Shawnee Kelly.
Hi, how's it going? Hey.
Shawnee Kelly,
Hey, Rudy.
Press Group, DSP Realty. So this is the most excitement you're going to see in this video because today we are talking about
Money. Numbers.
So we're talking about numbers on how to determine how much money you're going to get from the sale of your home so that if you're using it to buy another home, you know how much you're going to have for your down payment. So we're going to just walk through that. Shouldn't take us too long. Kelly's going to be extremely bored.
I'd really rather talk about the colors
Yes.
that you want to paint your house and all of that. But
yes,
this is good too. This is kind of important.
So in the sister video to this one, in which we talked about the steps and what the considerations for buying and selling a home
at the same
time.
Mm-hmm.
I mentioned that you would see who built the display for it or who built the presentation. Yeah. And so we determined that Kelly built the presentation. So here we are with my PowerPoint presentation, and you will see.
It's going to be glorious.
It's going to be great. Vast difference. Anyway, here we go. Okay, how much can I use from the sale of a home to buy a home? So what we want to do is we want to help you determine, just because you sell a house for, let's say, $500,000 and you only owe $300,000 on your mortgage.
Do you get $200,000?
Do you get $200,000? Well, we'll see. So we're going to take you step by step so you know how to calculate that yourself.
Very good.
Okay.
This is very interesting.
So we're going to use this. We already explained what that is. So we're going to give you a sample scenario. So in this scenario, this does not include settlement costs. Okay. This is a sample scenario only. So for a seller, typically in your closing costs, you can account for about 3 to 4% of final closing costs. That includes commissions and closing fees and taxes and so on. But that's not included in what we're talking about now. So just wanted to be that clear. All right, so in this scenario, you bought a house for $500,000 and you put 20% down, so you have an instant $100,000 in equity on that house. Mm-hmm. Make sense?
That makes sense.
Any questions?
Not so far.
Okay. I want to make sure that what I put on here makes sense.
Okay, so then you sell it 5 years later for $800,000. Assuming, of course, you've paid down on...
Yeah, that's in here.
Okay.
Yeah. Okay, so...
I'm looking forward to that. I haven't put on my smart glasses. Really, it's because it was so small, but it makes me look like super number friendly.
You own this. All right, so you bought it for $500,000, put 20% down, so you had a mortgage for $400,000. Mm-hmm. You sell it 5 years later for $800,000. That's fantastic.
So you're like, I have $400,000 plus whatever I paid down on my mortgage.
There you go. At the time of the sale, the mortgage balance is now $350,000.
I get to put $350,000 down on my next house.
$450,000.
I meant $450,000. I really did mean that. I just got caught up.
You got, and you saw that number set $300,000.
Yeah.
Okay. And keeping them in
you
mind.
incepted a wrong number
That's
in my
right.
brain.
I'm sorry. Okay. All right. So cash at settlement that will go to the seller. Again, this does not include closing costs. Would be $450,000. Okay. Mm-hmm. So that's what we're going to work with. And as a seller, you'll know what your cash is going to be because the title company is going to give you what's called an Alta statement, which is a closing disclosure, and then you'll see how much money you're going to get.
Similar to the HUD, if you did it back in the days, it would be the HUD statement.
Yep. So you're going to plan on getting $450,000 cash, all right, or a check or wire. All right. So here's the thing about this. Okay, $300,000 of that is capital gains. $150,000 of that is equity/debt pay down. So how did we come to this?
What do you mean? Capital gains.
Capital gains. Okay, baby. So
and why is it in red? It makes me think you're about to touch it.
Because you got to be aware.
Some funny business.
We're going to do some tomfoolery with this. Okay. So your $450,000 cash is split into $300,000 and $150,000. Your $150,000 in equity and debt pay down comes from when you bought the house for $500,000. You had put $100,000 into the house. Okay, so that was off of that original $500,000.
So that's your money to keep, right? Like you instead of putting it in the bank in a savings account, you put it in your house.
Yep. And then you also, making your monthly payments, paid off $50,000 towards the mortgage. So you put another $50,000 in your bank that Kelly just referenced.
Yes.
So you have $150,000 that is no gain. Okay, that's not a gain. That's not
your
profit.
money that you took from one place and put into this place.
And it went towards the original sales price of $500,000. So there's no tax concern on that one. The $300,000, that's called capital gains. Okay, what are capital gains? Let's see, do I have
So
that
basically
on?
like profit, right?
Yeah.
So like if it cost me $5 to make this glasses case and I sold it to you for 10, this is the $5 profit.
That's right, yeah. So capital gains, it refers to an increase in a capital asset, your house or the glass case, that asset's value, and is considered to be realized when it is sold. So you don't have any taxable event on that capital gains until the property sells. Once the capital gains tax, or at the time that we recorded this, capital gains is between 15 and 20% depending on your income status.
How often does that fluctuate?
Usually with presidents.
Okay.
Yeah. But now I don't know that for sure, but that's just kind of what I think. I know that there's been some
But
fluctuations.
it does,
with that.
so you would have to check, but hey, I'm selling my house, you would want to look into it at that point. Okay.
So we have $300,000 in capital gains. So according to this definition, that $300,000 can be taxed at 15 to 20%. So that's somewhere between 45 and 60,000. So in that scenario, you don't have 450,000 to put towards the next house because you don't want to get hit with a huge tax bill. You now have 450,000 minus 45 to 60,000, whatever that comes out to. Okay, so that's why this is really important. You have to know how the sale of a house affects you as a taxable event. Okay, so how do we determine if you get to keep that whole $300,000 or if you have to get taxed on parts of it? How do we determine that? So how do we determine this?
Well, it is occupancy.
Yep.
I do know that. You have to have lived in it, not just owned it, but lived in it, your primary residence for 2 years.
Yep, 2 of the previous 5 years. Yep. So
you could have lived in it for the first 2 years and then moved out for the following 3? That would have been fine? Okay.
Yep, you could have rented it. Yep.
What about, and did they have to be consecutive? Could I live in it for 1 year, move out for 3 years, lived in it for another year, move out for a 5th year?
Yep, so it's just
What if I lived in it for
6 months? What if I lived in it for 6 months and 1 day?
Okay, so not consecutive, but cumulative 2 years within the previous 5 years.
Yeah. So if you get stationed and you think you might be coming back, so you rent the house out for a year or 2 thinking you're going to return, and then you find out you're not coming back to the area, you can still sell the house and get this capital gains exemption. So, yeah. All right, so did you occupy the house as a primary residence for 2 of the past 5 years?
In fact, I did.
You did?
Yes.
Well, what if you didn't? Let's go with
I
that
didn't.
first.
I was thinking of a different house.
That's right. So if you did not, then the property is considered an investment property. So you want to talk to an accountant because now that capital gains is fully taxable. And on top of that, you probably have some depreciation that could be recaptured. So there could be quite a bit of tax liability in the sale of that property. So you want to talk to an accountant. You want to talk to Kelly and myself to talk about your options for 1031 exchange, to where you can take that money and invest it in another real estate property without paying taxes, so you can use the full amount to buy another investment property, but there are criteria with that you have to do.
I'll be honest, it's best to talk to Sean about this, not the Aunt Kelly. You can talk to the Aunt Kelly about pretty much anything else real estate related, but this is, we're just gonna give you a good old redirect over here.
Okay, so the answer is no. Talk to me and we'll talk to your accountant so we can figure out what the best tax strategy is, because taxes are important.
Yes.
Okay? All right, but did you live in the house for the 2 of the previous 5 years?
Did.
Yes.
I said.
Okay. So if you did, there's some good news. All right. Capital gains exemptions. So here's how this works. If you're single and you lived in that house, then you get a $250,000 exemption. So in this scenario of this $300,000, only $50,000 is taxable at the 15 to 20% depending on your income.
That's a much better
It's a much better
tax hit. Yeah.
If you're married, then it's always such a benefit
What
to
if
be
I
married.
get married?
As long as you're, well,
Like, what if I get married? What if that's the whole reason I'm selling my house?
talk to your accountant. I don't know. I have no idea.
That's a good
I don't know.
question.
That is a good question. Yeah. I'm assuming
What if I'm married in my heart?
Okay, so what if you're married? Okay, if you're married, wait, you had
Married is such a benefit.
You had such good jokes in there, so I'm gonna cut this around that. Yeah. Okay, so marriage has a great benefit, and besides being married to someone like you, if you're married, this exemption doubles. So you have $500,000 in exemptions.
Is this why you married me?
That's why I married you,
Dang
for that
it!
exemption.
I thought it was my glorious long flowing locks.
Well, that's what it was. Yeah, that's the truth. So in this situation, if you're married and you lived in the house for 2 of the previous 5 years, then you get to use the full $300,000 and $150,000. So you have $450,000.
Did I have to live in it with my husband?
Yes. You about to got some swear words. All right, so that's how you calculate, okay? And this is very simple. We always recommend you talk to your accountant.
Yeah.
We are not accountants, but this is a
This
basic
is general
understanding.
Yeah.
Yes, because imagine if you didn't know this and you took that 450, you went and bought a house and you weren't married. Well, let's say you weren't married and you got hit with a, what is this, $7,500 to $10,000 tax bill. That's going to kind of make you a little bit mad, right?
Well, that'll buy you a really nice wedding dress.
Yeah, you should have gotten married.
Based on say yes to the dress.
It was a free dress if you did.
That's how you...
Okay, we digress. So anyway,
Okay.
this is how you calculate.
Only get married if you want to. I hear it's not for everyone.
Yep.
I've just been married my whole life, so it feels
right.
like there's no other way to do it.
That's right. I got you out of the womb.
Ooh.
Not really.
Nope.
All right.
We're so full of bad jokes.
We are so full of bad jokes. Now, if your capital gains is above $500,000, then anything above that would be taxed at the current capital
What if
gains
you're
rate.
married to more than one person? Could we?
I don't know. Talk to your accountant.
Maybe we could get a million.
Talk to your accountant and your priest.
And hey, hit me up. That's a capital gain. Just kidding.
All right, we'll see you on the next video. If you have any questions, please feel free to reach out to us.
We'll try to improve our jokes.
Yeah, a little bit.
I
All right.
will.